This is Friday, the 10th of January 2025, price action review. I will be covering the NQ and specifically look into the 3-day look back, time distortion, and the opening range gap. So looking at the daily chart, you can see the 3-day look back phenomenon take place. At least that's the tool that I utilized to derive the expectation of lower prices. You can see from counting today as day 1, then the previous day as day 2, and the day before it as day 3, annotating the previous day highs and lows of those individual candles. It offers us significant liquidity pools, and they are significant for the reason that they are previous day and previous day lows. And those are significant because banks and large funds trade off daily charts, so a lot of liquidity resides at those specific levels. We have an underlying bearish bias, expecting the market to trade from internal range to external range, specifically from this volume balance down to this previous week low in particular. And notice how a price trade found support at this weekly volume balance several times over the past weeks. But with today's trading, we closed below that weekly volume balance, and when we are going over the lower time frames, we can really see how price action on the lower time frame utilized that specific higher time frame PD array. Note how the price took out previous day high, which is within the look back, of course, and then traded lower to take out all daily lows, also within the look back, and then eventually targeting this previous week low, which was very clean, especially seen on the 4-hour chart, which I will go into now. But first, I wanted to have a quick look at the relative strength analysis between the 3 major indices. You can see that the Dow Jones is the relative weakness leader. Note how it has already seen a much more pronounced decline lower as compared to the NQ and the ES. Then the middle one is ES, which has seen a decline lower, but not as pronounced as IM, but more pronounced than NQ, making NQ the relative strength leader. So what can we do with this information? Well, concisely, I'm not trading the IM or the Dow Jones since I'm just not a fan of it. What you generally see, what you can see at least, is when, for example, NQ and ES both decline lower, then IM can actually be held in a consolidation of just actually go higher, especially on days with no news. So it's kind of a wild card, and I don't really like trading it, which is pretty logical that it's a wild card since the Dow Jones only makes up 30 stocks as compared to the NQ, which makes up 100 stocks, and ES 500. So that's that. But back to the topic which I was talking about here is in this case, ES has much more, at least some more pronounced declines lower as compared to NQ. So if you were trading it, you would actually, if you're looking to go short, you would elect to trade ES as compared to NQ because it has an easier time going lower. That was what I was looking for. Whereas NQ retracements, and for example in this case, a price took at previous week low, the return, the retracement after that previous week low has been rated, it was much more significant on the NQ as compared to ES. So in simple terms, shorts were better in ES and longs were better in NQ. So for our chart, you can see how a market maker style model is underway on the 4-hour chart. It is not the most clean market maker style model of all, which is pretty much what we were expecting due to it being this market maker style model formed within the end of December and now in January. And price action tend to be more high resistance in nature and overall more range bound consolidating. So this was pretty much the price action that you then could anticipate. Going over to the price action that is of significance today, we have seen that price indeed trade up in the daily volume balance. Notice how the bodies are staying below it on the 4-hour chart. Only a wick reaching up into what seems the upper quadrant, and then a salt of lower, also a convergence with this premium wick. Midpoint, I think it nails this, but I have to look at it later. Then price sells off lower and takes at the previous week low. Notice how it closes below the volume balance on the weekly chart, then trades back into that same volume balance and then sells off again, closing near that old previous week low. Very interesting to see how it utilized that weekly volume balance, which will be even more clear once we drop down to even lower time frames. How it uses this as a pretty much a dynamic support and resistance level, especially today. Looking at these red equal lows on the 4-hour chart, it is just a matter of time, in my opinion, before this will get rated as part of this market maker sell model. This makes up the original consolidation. So it will only be a matter of time before the market will continue to decline lower. For next week, I would like to see what would support this idea of lower prices. A run down below these lows is if the next candle can open up close below the midpoint of this wick, and that would really set up a stage for a run towards these lows. Say it showed a rejection. This, of course, you have to open up first. What I like to see is then a gap opening lower, then a return back up into the gap, and then sell off lower again. That would be pretty nice. But we have to see on Sunday, which is something no one can forecast. Alright, a 1-hour chart. Let's have a drink first. I'm actually doing like one and dones. I think that saves the most time and is probably the most efficient way of doing this, especially since editing takes quite a lot of time actually. And it's empty. Nice. So 1-hour chart, we can see a 1-hour market maker sell model fractal underway, which is pretty much encapsulated within that 4-hour market maker sell model, since price is fractal. So this is just a smaller fractal of the market maker sell model that we see on the 1-hour chart. I specifically want to dive into this consolidation here, which was not just a consolidation, it was actually time distortion. So why did I classify it as time distortion? Well, for the simple reason that we have NFP on Friday, a significant news driver, one of the most significant ones. And yesterday was actually a bank holiday, and in general Wednesday and Thursday it tends to be more range-bound consolidating, less precision elements, and specifically because of yesterday being a bank holiday, I anticipated Wednesday to also not be too much fireworks, let's put it that way. It's also more range-bound, and this is just pretty much just marking time in a way for the 8:30 news driver. So what I then generally do is only refer to the most key reference points inside of this range. So that would be this linear range low, and then this fair value gap. I could also have picked this low to refer to instead of this one, since this one actually had a lower close. But let's say we pick this one, because that's what I at least did today. We have this then 1-hour fair value gap. Then is this everything in between this linear range low and this fair value gap is what I pretty much ignored completely, since the algorithm is also going to ignore it. It is just going back to the main reference points, and since I was anticipating a decline lower as part of this 1-hour market maker sell model, this being my draw on liquidity, this previous week low, I was looking for the market to reach up into 1 hour into this 1 hour for value gap, either at the news, which was actually what I was anticipating when I woke up at that would be like 2 a.m. in London, New York time, which is 8 a.m. here. I was actually anticipating perhaps the news at NFP to reach up into this 1 hour for value gap and then the market to sell off lower, but we actually already reached up into it during the pre-market, and then NFP provided the distribution lower. But if you would imagine that this whole piece of price action, which makes up the time distortion, if you can just envision that this is just a cut out of this picture here, then you would actually see that just price reach up into this 1 hour for value gap. So let's say this piece of price action, then this is ignored. We can see that on price just reaching up into this 1 hour for value gap and then sells off lower. It's basically the time distortion is just basically throwing you off the underlying idea that's already underway, the underlying narrative that is already underway. You think, oh, it's consolidating, what is it going to do now? But if you can just identify it as time distortion and just cut it out, then you would see that this is just a logical retracement up into this 1 hour for value gap, reclaiming it, and then sending off lower. You might actually say that you can ignore everything, even this whole area of price action, and only refer to this 1 hour for value gap. And on this dealing range low, that would also make sense. And it's just really a retracement up into this fair value gap and then sells off. So basically, simply put, whenever there's time distortion and I identify it as time distortion, I'm just going to ignore it completely and only refer back to the main reference points, often the dealing range low, dealing range high, or a significant PD array, which I anticipate the market to potentially sell off from. And in this case, it's 1 hour for value gap. You can see that the market then trades lower. Notice how it then trades back up into the weekly volume imbalance, using it now as a resistance level to sell off lower. That's what it did. And these kind of signatures, that's what I'm looking for, especially on any time frame really. Notice how it reaches up into the lower quadrant of that weekly volume imbalance, falling short of CE, and then rapidly reprices lower to take out the previous week low. These kind of signatures, that's what I'm looking for. Really using it as an inversion level and then reaching for a draw, and then later on reversing, retracing is perhaps a better word, up into the volume imbalance again, and then that's better seen on the 50-minute chart. But very nice, interesting study was this. All right, dropping down into the 50-minute chart, you can see how the daily range has formed on the 50-minute chart. And notice how price took out these relative equal highs, which were all clean low resistance liquidity run signatures they had. Price took out those relative equal highs, which actually consist of a previous day high and previous London and Asia sell side buy side liquidity. So significant liquidity pools. Price took those relative equal highs out and then reversed, creating a turning point here. Notice also how price engineered sell side liquidity prior to that run up to take buy side. Way to clean those relative equal lows. You can actually draw a trend line from them, and usually when I see that, then I know that it will most likely get disrupted in the near future. So then I look for levels of buy side to be taken, and that's what was done here. Reversal at the 1 hour for value gap. Market showed significant displacement lower, change in the state of delivery here. Notice how price then retraces back up into this order block, which makes up the change in state of delivery. Also this inversion for value gap, which is not just a inversion for value gap, it is actually the last busy prior to the smart money reversal, which as we know is a high probability inversion for value gap once we enter the sell side of the curve. Price reaches up into this, specifically also a BPR. Notice how only a wick reaches up into the balanced price range. Then price trades lower. On the lower time frame, we can see a divergence here take place at the news release at NFP. In general, you always anticipate a measure of SMT to take place at these high impact news drivers, especially one like NFP. Market then sells off lower, then takes out all of these relative equal lows. Another one here. Lots of liquidity, price up in a premium, seeking discount. Notice price then trading down into the weekly volume imbalance. That weekly volume imbalance actually provides initial support. Notice how the bodies are still respecting the lower quadrant of that weekly volume imbalance. This is actually what the catalyst was for this retracement higher. But you don't anticipate this to be the bottom and that price then continue to go higher. That's actually what retail was probably thinking here. Since we created this short-term low here in a relative distance to this previous week low, creating an idea of support, making this low a engineered sell-side liquidity pool, since it's only engineering sell side with this rally up. Retail traders are going to see this rally up as a bottom has formed, going long, placing their stop loss below old lows, this one in particular. But all this is just a retracement up into a short-term premium, also defined by this high down to this low. Why not this high? This is the dealing range high, correct, but I would refer to this high specifically since this was the most energetic price run created at the news. I would refer to this then as a dealing range high. Of not dealing range high, but at least the high to determine premium discount. It's not a dealing range high, but if we define a premium discount from this high to this low, we can see price trades up into equilibrium to premium. Also converging with this bearish breaker, price reaches up into that. Notice the turn takes place at 9:30, so we have actually a Judas swing here taking place prior to 9:30, and then at 9:30 you can actually see the distribution take place. So price builds in a premium prior to the equity opening, and then at the equity opening price distributes lower, reaching below the previous week low. I will on the next slide dive into the opening range, since that was a major confluence and really just the basis for why I anticipated the market to sell off lower right from Jump Street. Price then takes the previous week low. Notice how then the news release at 10 a.m. that price actually takes out that previously low at the news release, so that also accelerated decline lower. Then retraces up into this bearish order block and weekly volume balance, another time that it provided resistance now. So it's now acting as an inversion, converging with this bearish order block. Then I was actually looking for a offset distribution, meaning that price takes out a significant sell-side liquidity pool, then retraces up into a premium array, and then sells off lower again to take out that a low that has formed already at that sell-side liquidity pool as offset distribution. For the same idea here, that this is then enticing traders that the bottom is in, they are going long, only to reach up into a premium and then sell off lower again to take out those stops here. But it didn't. Why? Because of SMT. So I have SMT taking place between the AM low and the lunch hour low. Whereas on ES, it did actually what I was anticipating to see on NQ. But we come back to the second slide. NQ is a relative strength leader. So whenever a market is a relative strength leader, I anticipate, at least, perhaps anticipate is not the right word, but it is more likely that an SMT takes place in the form of a lower high, of a higher low in a market that is the relative strength leader, as compared to a market that is the relative weakness leader. So simply put, you can, when in this case NQ is the relative weakness leader, then you can anticipate to see, for at least the probability is higher that NQ will form a higher low than ES. That was very confusing, but I at least somewhat understand what I meant. So then the lunch hour is running against the traders who are profitable in the EM session. Very textbook scenario. The market has been declining all the way since 8:30. Then at 9:30, the same thing happens, just continue to decline lower. Then the lunch hour will generally trade against the trades who are profitable in the EM session. In this case, we're just the shorts. So the market runs against them, taking out this very specific high, which is the most recent high that formed in the AM session. That's a really textbook target to reach for. Whenever you have this scenario here, when you anticipate lunch to run against the traders who are profitable in AM, and the market has been going lower, and we met a significant sales liquidity pool, then the most recent AM session high is a really, really good target. Like always, and almost always forms around 11 a.m. Sometimes just before 11 a.m. and sometimes was almost always around 11 a.m. And this was the case too. I think it formed like 10:50 or something like that. So price takes it that high, reaches back into the weekly volume imbalance, into this bearish order block, actually reclaiming this SIBI, this large one, trading lower and then closing near equilibrium, defined by this dealing range low and this dealing range high. It's around equilibrium here. Then a quick look to the power of 3. You can see that we open up here, then trade lower from the opening. Very textbook. Then the market as a market protraction above the opening price. Notice how quickly it does that. Very small range candles here within this consolidation, and then boom, large consecutive up close candles, clear manipulation. Actually happening throughout London lunch, which was not what I anticipated the moment I woke up, but when I saw it happening, it became clear that this would be the manipulation, taking out these relative equal highs. And I already went over that, but what I want to go into was that notice how then the high of the day forms here. We have accumulation, manipulation, then distribution. Notice the significance of the opening prices once again. This is really a gem. Open, high, low, close is really everything. Notice how the high probability shorts formed here above the opening price. Then price sold off lower, going into range expansion. Notice how it pretty much flips the opening price, you can say in retail terms. Notice how price trades below the opening price again, then reaches back up into the opening price. And then at NFP, notice how the bodies are respecting that opening price at midnight and at 8:30. And then a little bit manipulation above the 8:30 opening price. And then going lower again, range expansion, low of the day, and then eventually closing near the low of the day. Alright, going to the opening range gap. I actually watched and studied the most recent ICT lecture. I think the same day of NFP. I actually watched during London lunch, which is usually a time when I have time, when I study then ICT throughout the week. Since there's not really usually nothing that interesting. Let's cut that shit out, buddy. Alright, going into the opening range gap, which was a very significant idea really of today's price action. So I recently studied the most recent video of IST where he's talking about the opening range, and one of the things that he mentioned was whenever you have a large opening range gap, and large is defined by 100 20 handles or more, and then generally price yeah, potentially is perhaps the better word, price can continue to trade in the direction of the opening range gap, and as a result the gap will remain open. And I added to this in this screenshot, which I actually made in real time, at least until the sell side liquidity draw has been met. So it was really cool to see how just what I recently learned take place and unfold the exact same day. Of course, I knew about the opening range gap, and I knew because I still already taught it in his live streams that whenever it's large, you can pretty much anticipate to remain open. But it was very cool to have that to way to quantify it better with the 120 handles or more. So I measured it the moment the opening range was created at 9:30, and I identified that it was 186 handles, and it's a large discount opening range gap since we opened up lower as compared to the previous day closing price. And I already had the bias being bearish in mind, so I was already looking for that sell side liquidity draw in the form of the previous week low. So this all the more further solidified my anticipation of the gap to remain open at least until that previous week low has been taken out. Afterwards, I had to see, had to consider, are we going to continue lower? I actually did some demo trades today, and I perhaps make another video about that. I was actually riding that decline lower into that previous week low, and then traded long on the buy side of the curve, targeting that opening range gap, but it never got retraded back to. But the main idea was really that it was very cool to see how the idea that ICT taught literally unfolded the very next day, and really helped me a lot in today's price action to be able to anticipate the gap to remain unfilled and continue to look for lower prices instead of immediately aiming back to reach back into that gap on the basis of like the standard rule that 70% of the time a price will retrace back into the opening range gap, and then specifically the midpoint of it, and that this is one of the main caveats to that idea when it is over 120 handles or 120 handles. There was of course a gray line of a gray area, but that was not applicable today, and it was very cool to see. Dropping down the 1 minute chart, you can see this is actually a little mistake. It was of course 168 handles, but you can see that price indeed continued to trade lower and eventually reaching for the previous week low. And when we go to the next slide, you can see that price never returned back into that opening range gap, and just completely left it unfilled for today. It did make an attempt throughout lunch hour and the start of the PM session to reach back up into it, but it failed to do so. I might make a different video because I did actually several trades here, but I have to see, perhaps that tomorrow I have some time to do that, but I have to keep my priorities straight. Alright, 5-minute chart. In closing, you can see everything more defined in the 5 minutes. This inversion for value gap is what I had refined to the 5-minute chart. You can see how indeed price respected that specific level, how SMT took place at those highs. With yes, we also had an SMT with the Dow Jones, but I almost always like to refer to ES. When it comes to SMT, I just think it's much more trustworthy, and that's actually the main reason. Generally, trades that have SMT with yes, in my experience at least, are much more trustworthy than when it's only with IM. If it's both, it's fine, but on AM, I think it's more tricky. Then I have to really be in sync with each other, and that's not always the case. Market sells off at NFP, taking out all these significant levels of sell side liquidity, and also the ones that formed inside of this the new wick opening gap, just leaving that new wick opening gap and never returning back into it. Another sign of underlying weakness. And then the market retraces back up into this breaker, also converging with these old lows. So that's also another reason why I would not look for a complete gap closure or even reaching up into the upper quadrant. Really just anticipating it just to reach up into equilibrium to premium and then just continue to trade lower. This was a very, very nice signature, by the way. Notice how price reaches up into this inverse discount wick and then the midpoint of it, really nailing it. Just a very mohawk, a little mohawk above it, and then selling off lower to take out this engineered sales liquidity pool. Tracing one more time into this fair value gap. Notice the precision elements, and then taking a previous week low. Why was it, by the way, why did I even annotate this as an inverse discount wick? It's such a long word, but now I think it's the best way to quantify it. Like you have like a standard rule of it. This was initially a discount wick, but once trade below, it becomes an inversion level, and price reaches up into this. Also a breaker here, so several convergences there. Then eventually price reverses there, reverses closely after the medium impact news. We're tracing back up into this bearish breaker. Notice then how price respects mean threshold of this bearish breaker and then with the bodies, and then only a wick reaches up into the rejection block. That's very nice to see. Bodies really just staying below it and also staying below the weekly volume balance. Very, very nice precision elements. What more do you need in terms of convincing someone to that this is really controlled when price literally stops specifically at these levels? The market then trades lower. I was looking again for offset distribution here, but we have SMT, time-based liquidity. The market then reverses, change in state of delivery here. Market trades above the opening price of this down close candle. It's not needed for a body to close above this opening price. No, a wick is all that's necessary for a change in state delivery to pretty much be activated. Then the next candle opens up and trades down into this bullish order block, change in state delivery, and then continues to trade higher. You don't see the return back into it like when it moves higher and then comes back down into it. No, but that's not required, especially not when you are like throughout the lunch hour attacking those most recent AM high. You tend to see like a very quick move higher towards that level of buy side, especially when you have some consolidation out of it. And that's what we had. Market uses this SIBI on the sell side of the curve as an inversion for value gap on the buy side of the curve, finding support there and eventually reaching for the most recent AM high. And then eventually the market drops down lower. Drops lower is actually, I think, proper English. And then closing near equilibrium. Very textbook for like a ranging session, because that's basically what it was. To close near equilibrium, and that's what I did. So I think that's gonna be it for today. I might make another trade review, some entry drills that I did today, but that can also be later done. So we'll see.